The market is open, and we are tracking Opendoor Technologies, ticker symbol OPEN, trading live at exactly $7.83 per share, pushing up roughly 0.67% on this abbreviated Black Friday trading session. The volume is ticking over steadily, sitting just above 15 million shares traded so far today, which is significant given the shortened hours. If you are watching the order book on your Fidelity trading platform or checking the charts on Webbull, you are seeing a stock that has arguably staged one of the most violent reversals of 2025. We are not just looking at a daily fluctuation here. We are looking at a company that was priced for bankruptcy, literally trading near 50 cents back in June, now sitting firmly near the $8 mark. That is not a typo. The equity has moved over 1,300% in under 6 months. This brings us directly to the tension between expectation and reality, which is where the real story lies for Opendoor right now. The expectation, held by a vast majority of retail traders and even seasoned analysts on Interactive Brokers, was that Opendoor was the next Zillow Offers, a failed experiment destined to bleed cash until it hit zero. The narrative was simple. High interest rates break the iBuying model, inventory depreciates faster than it can be sold, and the algorithm fails when the housing market freezes. That was the expectation. The reality, however, has been a masterclass in financial engineering and a pivot so aggressive it has caught almost every short seller off guard. The reality is that Opendoor didn't just survive the rate hike cycle, they fundamentally altered their capital structure and business focus under the new CEO Kaz Nejatian, effectively refounding the company while the market was looking the other way. When you look at the chart, you might think this is just a meme rally, similar to what we occasionally see with GameStop or AMC. But the drivers here are mechanical, not just social. The recent distribution of tradable warrants to shareholders on November 21st was a strategic maneuver that forces us to rethink the bear case. By issuing these warrants, management essentially created a complex derivative structure attached to the common equity, which complicates the thesis for anyone holding a short position. If you are short the stock, you are now potentially liable for the warrant dividend, a headache that many institutional shorts who might be managing their positions through Schwab Intelligent Portfolios or a Fidelity brokerage account simply do not want to deal with. This has triggered a covering rally that feeds on itself, pushing the price higher regardless of the immediate fundamental picture of the housing market. Let's analyze the immediate price action we are seeing today. The stock opened at $7.92, dipped to a low of $7.80, and is now grinding back up toward that $7.85 level. It is consolidating recent gains. In a typical market environment, a stock up 1,300% in half a year would be ripe for a massive pullback, a sell the news event. Yet the bid remains strong. Why? Because the market is beginning to price in a 2026 where mortgage rates settle closer to 6% rather than 7 or 8%. The Federal Reserve's signals earlier this year and the subsequent stabilization in the 10-year Treasury yield have given iBuyers breathing room. Opendoor's spread, the difference between what they buy a home for and what they sell it for, is highly sensitive to these rate movements. When rates stabilize, their holding costs become predictable. When holding costs are predictable, the algorithm can actually function as intended. We need to discuss the specific volume dynamics we are seeing. On a day like today, when many traders are out for the holiday, you would expect thin liquidity. Usually, thin liquidity leads to chop. Instead, we are seeing structured buying support at the $7.80 level. This suggests institutional accumulation, or at the very least, a lack of institutional distribution. They aren't dumping. If you look at the flow on Interactive Brokers stock trading dashboards, the block orders aren't indicating a mass exit. This is crucial because it implies that the smart capital, the funds that usually move before the retail crowd on Robinhood or SoFi Invest catches on, is willing to hold through this volatility. They are betting that the refounding of Opendoor is not just a slogan, but a tangible shift in unit economics. Now, let's address the elephant in the room, the business model itself. For those who have been tracking Tesla stock or Nvidia stock, you're used to companies that create products. Opendoor deals in arguably the most illiquid asset class in the world, residential real estate. The old Opendoor was a brute force market maker. They used billions in debt to buy thousands of homes, hoping to flip them for a thin margin. It worked when capital was cheap. It was a disaster when capital became expensive. The new Opendoor, the one that justifies this $7.83 price tag, is trying to become a platform. They are pushing Opendoor exclusives, a marketplace that connects buyers and sellers directly, allowing Opendoor to take a fee without necessarily taking the capital risk of owning the home. It's a shift from being a massive real estate hedge fund to being a software company that facilitates transactions. This shift is why you see comparisons to companies like Apple stock, not because Opendoor is anywhere near Apple's quality, but because the market rewards platform businesses with higher multiples than asset-heavy businesses. If Opendoor can prove that a significant chunk of its revenue in 2026 will come from services rather than flipping houses, the valuation changes completely. It stops trading at a fraction of book value and starts trading on a multiple of software-like earnings. That is the blue sky scenario that bulls are pricing in. They are betting that the interface you see on the Opendoor app will eventually be the default way to sell a home, bypassing the traditional 6% agent commission structure, much like how Robinhood stock trading bypassed traditional brokerage fees. However, we must remain grounded. The financials are still messy. Revenue for the third quarter of 2025 came in between $800 million and $875 million. That is a sharp contraction from the multi-billion-dollar quarters of 2021 and 2022. They are shrinking to grow. They are selling fewer homes because they are buying fewer homes, being far more selective with their buy box. This discipline is healthy, but it means the top-line growth that growth investors usually crave is absent. You're not buying growth right now. You're buying a turnaround. You are buying the idea that the bleeding has stopped. The adjusted EBITDA moving from massive losses to near break-even or slight profitability is the signal that the operational leverage is kicking in. Let's talk about the retail investor sentiment because it's a huge factor here. If you scroll through forums or look at the chatter on SoFi active investing boards, the sentiment has shifted from despair to euphoria. There's a psychological element at play. When a stock trades below $1, it is viewed as dead. When it crosses $5, it becomes investable again for many funds that have minimum price mandates. Crossing that $5 threshold was a massive technical catalyst. Now that it is approaching $8, it's attracting momentum traders who don't care about the fundamentals. They only care about the trend. This creates a feedback loop. The higher it goes, the more legit it looks. The more legit it looks, the more capital flows in from individual brokerage accounts and even Fidelity Wealth Management clients who are looking for high beta exposure to a housing recovery. I want you to pause for a second and think about your own exposure. Comment below how many shares of Opendoor you currently hold, or if you are staying on the sidelines. Are you one of the brave souls who bought at $0.51, or are you chasing it here at $7.83? I want to know if you think this rally is sustainable or if we are setting up for another crash. We also need to consider the broader ecosystem of online investing. Platforms like Schwab's Intelligent Portfolios or SoFi Robo-Advisor services are constantly rebalancing asset allocations. As real estate as a sector heats up, these automated algorithms might start increasing exposure to the sector ETFs that hold Opendoor. It's a passive flow of capital that can buoy the price action independent of news. Furthermore, with the holiday season upon us, trading volumes typically dry up, which can exacerbate moves. A small amount of buying pressure on a half-day like today can have an outsized impact on the price. That is exactly what we are seeing, a drift higher on lower than average volume, which is a classic bullish consolidation signal. There's also a competitive angle to consider. Zillow and Redfin have largely retreated from iBuying or scaled it back significantly. Opendoor is the last major player standing, committed to the model, albeit a revised version of it. This gives them a monopoly on the instant offer value proposition. In a world where convenience is king, think about how Amazon changed retail or how Robinhood cash management changed banking. The ability to sell a house in a few clicks is still a potent product. The question has never been, do people want this? The question has always been, can you do this without going bankrupt? The market is starting to answer yes to the second question. Let's look at the risks, because ignoring them would be malpractice. The housing market is not out of the woods. Affordability is still at historical